Let me hit you with a real question. If someone handed you a pen and a napkin right now, could you tell them how your business is doing? Not pretty good or not we're staying busy. I mean, can you write down 5 real numbers that actually measure the health of your business? Because if you can't explain it on a napkin, you don't understand it. That's where the napkin scorecard comes in. What is the napkin scorecard? It's a simple, no fluff, field ready checklist of 5 numbers that every contractor should track, monthly, quarterly, tattooed on their brain. Not 50 metrics, not a spreadsheet jungle, just 5 ratios that tell you if your business is profitable, bankable, scalable, and most importantly, sustainable. So let's go through the 5 napkin ratios. The first one is your net profit margin. That is your net profit divided by your revenue. Why does it matter? Well, busy doesn't mean profitable. This ratio shows you what you keep, not just what you make. So what is your napkin target? At least 10% or more. The second one is gross margin. That's calculated by your revenue minus your job costs divided by your revenue. So why does that one matter? Well, basically, if the job eats too much, nothing's left for the office or you. So basically, that's asking if the job eats too much, nothing's left for the office or you. So what should be the napkin target? Well, it depends on the type of construction, but typically 30 to 40%. But again, you should probably adjust that for your type of construction. Number 3 is the cash conversion cycle. And that's calculated by the days sales outstanding plus your days inventory outstanding minus your days payable outstanding. We'll get into that more in the series, but why does that matter? Well, basically it measures how long your money is stuck in limbo. If it's too long, you're broke even if you're profitable. So what is the napkin target? Well, I would say at least under 60 days. And we'll get into more about what that means as we get into the series. Number 4, the debt service coverage ratio. Or you may want to abbreviate it DSCR. That is basically your net operating income divided by your debt payments. So why does that matter? Well, it's asking, can you actually afford the debt you have? So what we're trying to do is find for a target, what we'll call our napkin target, we want that number to be at least 1.25 or higher. And the 5th ratio that we're talking about today is what we call the book to bill ratio. So basically, it's your new contracts divided by your revenue. So why does this one matter? Basically, it's asking the question, are you booking enough future work to keep going? So what's the napkin target? Well, we want it to be 1.1 or more. Let me throw in one more bonus ratio while we're at it. And, this is optional if you got space on your napkin. There's the retainage ratio. That's asking how much of your money is being held hostage. There's the working capital turnover. That's asking, is your cash actually working for you, or is it just parked somewhere? There's the overhead ratio. That's also asking how much of your top line gets eaten by the office. So let's talk about how to use this scorecard. Well, at least once a month, pull your numbers, your revenue, your job costs, your net profit, your accounts receivable, your accounts payable, your debt, new contracts, and then write them down on a napkin or whatever you got handy. Write them down on a napkin, a whiteboard, a dashboard, wherever you want to put it. And the third step is don't look at them in isolation. Watch the trends over time. Are you getting healthier or are you just getting by? So to wrap this up, you don't need a CFO to run a smart construction business. You just need a napkin, a pen, and the guts to face the truth. Because the guy who tracks these 5 ratios, he doesn't get surprised by cash crunches. He doesn't panic when the bank asks for a report. And he doesn't run a busy company. He runs a profitable one. So grab a napkin, write down your 5, and start building a business that you can measure and trust.